The market had a nice bounce on Friday, but overall, it seems that negative sentiment continues to weigh down on equities.
Yeah, hi Sam. Indeed, there's definitely negative sentiment for equity markets in Nigeria right now. Year to date, the market is down just over 18%, and even though it's much better than what we will see in the likes of Kenya, it's still something that is worrying local investors and, of course, foreign investors. As you know, foreign investors tend to dominate the market right now, and, of course, with the headwinds in Europe right now, there is a lot of risk aversion, and fewer investors are coming to Nigeria right now. But just to get a broader perspective on the macro issues, let me speak to Mandela Toyo, and he joins us in the studio today. Thanks, Mandela, for joining us on the show. First of all, let's get your thoughts on the money supply numbers that came out recently. We've seen for the first time in 12 months, money supply numbers coming down. Some might argue that that's positive in the light of the plans by the central bank to tighten and, of course, rein in inflation.
Yeah, well, we saw the numbers from the central bank last week. We saw M1 and M2 monies come down about 3.5 and about 3.6% respectively. It's the first time it's happened in 12 months. And we just kind of disaggregated the drivers behind the slope or the slump in both monetary aggregates to see that it was largely on the back of a lot of the open market operations the central bank had kind of taken up. Also, we would attribute a bit of it to just sort of a slowdown in the amount of economic activity that's taking place as a result of the hikes in NPR. But largely it was a result of what the CBN is doing in terms of OMO. The broader implication is really something of an inflation story. The central bank of Nigeria has come out to, at the last MPC meeting at least, to make it clear that inflation was at levels which it thought it could sort of deal with. And really the sense we get is that if the downward trend continues, we're likely to see a situation where inflation might taper down. Our regression analysis shows that the broad monetary aggregates M1 and M2 are significant drivers of inflation, and so our expectation is that if there's a downtrend, we're likely to see some sort of moderation in inflation if that's the trend going forward.
Okay, let's talk a bit about the OMO policy. How sustainable is it? Because it's definitely coming at a cost where interest rates are right now. Obviously, for the central bank to intervene at the current levels, they are spending quite a lot more.
Yeah, as a matter of fact, just in the month of October, we saw the central bank reserves, which are an indication of how much the central bank is holding in currency, rise about 80%. It's at its highest level since 2000, January 2000, when we have data on this specific aggregate. And if you look at what the central bank has been doing in terms of the monetary policy rate, every time they hike the MPR, it effectively means that they have to pay more for the monies which are in their custody, specifically monies under the CRR and monies which they take in terms of OMO. At the last MPR, prior to the last MPR, we saw 91-day and 182-day bills mint at about 14.8% and just under 16% for the 91 and 182 respectively. Since the MPR decided not to hike rates, also the MPC decided not to hike rates, we've seen those rates come down significantly. The sense I get is that the decision by the central bank not to hike rates might have somewhat been related to the fact that they've taken on significant amounts of liquidity in terms of their open market operations, and just at a cost, obviously. And hiking those rates would have meant that there's going to be a lot more to pay in terms of keeping those monies in-house. So the sense that I get is that even though the CBN had decided to stay their hand, we might have a situation where OMO might not be as aggressive going forward as it has been in the past. Just last week, after the MPC decision, we've seen them scale back slightly on the amount of OMO they've been doing. We got about 100 billion in bills just at the later part of last week, and most of that money was just to refinance an existing position. So the sense I get is that at the current levels, it might be very expensive for the central bank to continue to tighten policy, and that might weigh significantly on their decisions going forward.
But what does that do for liquidity in the market? More so because we know that the AMCON bonds have now come into play, if you like. We've seen quite a few banks repo those bonds to get liquidity, given the tightening we've seen with the cash reserve ratio and, of course, the MPR. Give us your thoughts on the implications for the market in terms of liquidity, more so because we are seeing these AMCON bonds being repoed at the moment?
Specifically on the issue of AMCON bonds, the sense that we get is that a lot of the banks which hold significant positions in those AMCON bonds and were also net takers from the interbank market have sort of been forced to go back to the CBN. Have sort of had recourse to the CBN because they needed liquidity to meet their liabilities. This is because simply the interbank market had become slightly much more expensive for those takers because of obviously the MPR hikes in October, as well as the CRR requirements. So a lot of the placers in the market had sort of come in and just kind of taken out the funds to meet some of those obligations which the CBN had sort of placed on them. In terms of what the outlook for liquidity will be going forward, I just expect that as long as things remain where they are, these banks are likely to continue to have recourse to the central bank in order to sort of to raise liquidity.
So you expect liquidity
cheaply.
pressure going forward?
Yeah, liquidity pressure going forward.
Okay.